Good afternoon and welcome to BizTech's Asian Midday Market Watch. It's the 15th of November and we have our guest who has not been on the show for a while, Phan Vee Leung, founder of and CIO of Track Record Asia, as our guest today. V, it's been great to have you on the show again after quite a long absence, even though you're on the show almost every week on Inside Trading.
Yep, that's right. It's good to be back, right? So let's talk about markets.
Now, V, for a start, we've had a softer than expected US inflation numbers, and basically the US CPI was flat in October against economists' expectations of a 0.1% rise. Markets have responded across Asia. They're up sharply. What's your take on this?
Well, it is a very significant data point. I think it marks the confirmation for investors right now that we have seen the last rate hike of this interest rate hiking cycle by the US Federal Reserve. And that's quite important because we saw prior to the number there was still a chance of a hike before in the December meeting, like around 15% chance, and now that's completely priced out. And in fact, the chance of a change in policy is now 30% chance in the March meeting for an interest rate cut. So that is the first time we've seen in this cycle that no more interest rate hikes are being priced, and in fact, the change that is being priced now is an interest rate cut in the near future. And as you mentioned, the markets are responding very positively to it. It's not just the numbers are green all across Asian time zone now, but it's also because the US stock markets responded strongly. Most of the major indices was up nearly 2%, Nasdaq was up more than 2%. Interest rates in the longer term, in the longer tenors, meaning the longer maturities, the US bond yields fell across the board as well. In the 2-year sector, it fell around 22 basis points. That's like 0.22%, and that's a big move for a data point that is very, very important. And this is as we have been mentioning, I think the Fed has done enough to ensure that inflation is headed towards a 2% target. And in fact, I think they will be surprised when it's very clear to them that it's heading decisively towards a 2% target. It will most likely undershoot target, and then they will have to talk about the fact that as inflation falls, and if nominal interest rates, which is their policy benchmark interest rates, remain the same, real interest rates, which is nominal interest rates minus inflation, is much higher than they wanted, and policy is becoming more restrictive as inflation falls. And as economy slows, and as we have seen with the US job numbers in recent months, it is likely that they will talk about more interest rate adjustments, which is in fact to bring interest rates to a much lower level.
Now we have a slightly different problem now in Japan, because on the Japanese side of the equation, the inflation is running higher than BOJ's target. And also, we're now starting to see that the Japanese economy is shrinking faster than expected.
Yes. Well, the Japan by itself is a very difficult market to understand. In fact, as you mentioned, it's a very different ball game in Japan right now, all across the major economies as well as the emerging economies around the world. The central bankers are struggling with ensuring that inflation is going lower, but Japan still is playing the previous ball game of trying to ensure that inflation is heading higher. Though for months now, inflation has been above their 2% target, they still relentlessly insist that inflation, if without their unlimited money printing, they believe that inflation will drop very quickly below the target, and they want to ensure that it's above target. And this is, I think, there's a saying across among veteran traders that many parking lots around the world are littered with are full of homeless people pushing their cart and muttering that that interest rates in Japan should be going higher, right? So this is an old joke, but it is true. Nobody really knows what the BOJ is thinking. I think they are fighting the wrong war, but they insist on uh, ensuring that they will ensure that they will keep interest rates lower for longer, although inflation is a problem for the consumers. But as you said, the data is now showing that the economy is slowing faster than expected, and that's likely to keep them insisting that they need to keep printing money for a long time to come.
Now, then the other side of the equation, China, where you basically have, well, today, positive numbers out of China. Retail sales grew faster than expected, so did industrial production, but they have a different problem there as well. It's more of a deflationary problem.
Yes, correct. I think what we the problem that the Chinese economy is facing now is essentially a self-generated problem, self-generated by them their government policies, which were they were very focused on common prosperity, and common prosperity usually means the masses, which are the poorer population. They need to upgrade their lifestyle a little bit, and at the expense of the rich and the markets, right? So what we've been seeing is, because of the relentless imposition of sanctions on the big tech companies, on the big like for example the educational companies as well, what we are seeing is the economy slowing down, entrepreneurs reluctant to put money to put capital to work, and but that is something that they have said that it's over. They're now very focused on boosting the economy, and although, as you mentioned, we are seeing industrial production, GDP outperform expectations, but it still remains quite low with respect to what they want it to be. And the problem is deflation. We are seeing deflation based on the CPI, based on the consumer price index, as well as the producer price index. And I think it's very clear that the resolve of the Chinese government to implement more policies to boost the economy is strong, and that's likely to that's likely to be seen in the weeks and months ahead from their policymakers. And there's many people who are currently very bearish on Chinese markets because it's been performing that way for some time now. I think we are seeing the turnaround now, and in the months ahead, I think we will come to realize that we have seen the bottom in the risk assets markets in China.
Now, on that note, V, thank you very much for your insights. Thank you for coming on the show.
Cheers.
Now, we've been speaking to Phan Vee Leung. He's the founder and CIO of Track Record Asia. This has been BizTech's Asian Midday Market Watch. I'm Brian Fernandez. Check out the show on our website, www.biztech.asia, as well as our syndication partners, TV stations, radio stations, and websites. Thanks a lot for tuning in.